Welcome to Crashes and Taxes. I am your host for this podcast, Rebecca Walser. I'm so excited to be with you here, especially after the really incredible feedback we got from last week's podcast. And we got a lot of questions and a lot of people sending me their specific situations and saying, hey, this is my situation. What should I do? And I love those questions, but obviously I'm running a wealth management practice, Walser Wealth Management, and we do this professionally for a living. So we definitely have clients retain us, and then we will work. This podcast is really not me generating business for the practice, as it is me just sharing with the general viewing audience all my thoughts on what's going on the markets and taxes and politics. If you read the full name of the podcast, it's Crashes and Taxes, and basically how politics impacts all of that, because you really can't separate those things. And who's running the world definitely has an impact on both the markets, the Federal Reserve, and obviously on tax policy. So we definitely discuss all of those things here on Crashes and Taxes. And so what we thought we would do is we would generally do a general podcast around market asset classes and going through them, dissecting them on this podcast one at a time, and the specific challenges that are presented right now in 2022 for each different asset class. And then that will give you a much better understanding of how we and what tools we have at our disposal to use. And then I would just encourage you to either contact our practice and go through the channels of actually becoming a client, in which case you'll get professional advice with us, or certainly finding your own expert, your own financial professional that you're comfortable with, that it aligns with your values, your goals, and work with those people, because we definitely want you to have. It would be really hard to be a lay person not in the financial world and navigating this particular unique set of circumstances in 2022. So with that, let's get started on what actual asset classes are available and where can we make returns. I always start with this thing, my book is a really good book to give you an idea of long-term trends in markets and also risk management tools that we leverage all the time in the practice. So if you have not read my book, definitely read that book, Wealth Unbroken. It's available on Amazon, Barnes and Nobles, Target, Walmart, everywhere you can buy a book, you can get Wealth Unbroken. It's in the library. Definitely read that book. It'll give you a really great understanding of not only how the market works, but also how we balance risk management tools with the market to control volatility. So that's a really good book to read if you haven't read it before. For those of you that have never joined me before and you don't know necessarily, maybe someone referred you to the podcast, because we've had a lot of incredible growth with the podcast organically, and we appreciate that. Please tell your friends, tell your family about Crashes and Taxes. Let them know where they can get to it. Send them a link. Give us a 5-star review that you like the information, that you want to keep getting the information. I do this because I have a passion and a mission to give you guys as much information as I can publicly, and to help you understand what we're navigating, not because we're trying to monetize it and make money off of it, but because we really genuinely want the information out there for you at your fingertips. And if it turns into you wanting to do business with our practice, that's great. That's separate and apart. But again, definitely in 2022, everybody needs to consider seeking professional help because of the nuances going on globally in 2022. So let's go on now. And I want to start talking about the asset classes that we're actually leveraging in 2022. And so you can see here, I've got them, and we're going to go through these 4 main sectors. They're really just asset classes, and we'll discuss exactly what the options are. So the first thing we have is ownership, and that would be equity. I have equity in a company, and I can have equity in a public company by owning a share of stock. I hold stock certificates digitally for ownership representation of that company. So equities are typically, a long-term trajectory and a long-term play. And you can you can either do equities really well, really one of two ways. You can be a technical trader and trade within technical bounds, upper bounds, lower bounds, resistance points, tracking the 200 moving day average with the 50 moving day average, following some technical rules on that. And so a lot of people make short-term price fluctuation income by being traders. And so those are our day traders, or our pretty much day traders, I would say, in this market. You're trading on a frequently basis, and you're really making money on just price movements based on technical indicators of where the price is going to trade in the next few hours, or even just today. And so those are people that really follow technical rules, understand the trade indicators of a movement up or a movement down in the very short term. Institutional money really leads a lot of that. Algos really lead a lot of that. And those are our day traders that are making very short-term profits. Those types of people that do that professionally can actually make money even in a declining market, because they are trading against price movements. They're making money on price movements in and of themselves. So they're not looking for the underlying asset of the stock to actually appreciate in value, because they can trade against the stock and against the movement of the trajectory of the stock. So those are day traders. Then you've got the other side of that coin, which are just your long-term investors. And those are people that maybe have a 20 plus year runway. So people that are in their 30s, their 40s, that really say, hey, I've got 20 plus years to work. And so even if this market routes completely down and I lose everything, I'm not selling, I'm holding for the next 20 years. And over the next 20 years, the market will work itself out well enough that I have made a long-term profit. So if you look at the S&P 500 going back to 1929, and the S&P 500 started in 1956, so it's emulated back to the 1920s because it didn't exist before 56, obviously. If you emulate it back and you look at the returns from the 1920s through present day, 2021 ending, you'll see that we have double-digit return as an average. But if you then look and break down 2000 to 2021, what you're going to see is from 2000 through 2009, we have what we call the lost decade. That is a 10-year period, because 2000 is year one. So that 10-year period, 2000, 2009, the market actually went down even when you include dividends, -1%. We call that our lost decade. That is the first and only time in a 10-year period that the equity market actually lost money over 10 years. So that lost decade, it was an anomaly because it had never happened before, hasn't happened since. So over time, the market can be considered to be a long-term wealth grower. Now, we have things happening in 2022 that could interrupt that and certainly change that analysis and that trajectory. But for the most part, if you're day trading with technical rules and you're familiar with those and you're able to make money on the price movements, and that's really where you're making your money, is on price movements on day trading, versus you want to be a long-term investor and you're okay with the market coming down substantially because you know that you'll be able to pull it back up through holding for so many years, then you can really rely on the fact that the market over time, over a long runway, will usually always go up. That has been our case. What's different in 2022 with equity positions is the fact that if you look at, and last week's podcast was probably the best example of this. We looked at the M1 money supply from from Fred, which is the Federal Reserve reporting. We looked at the M1 money supply from the 90s through present day, 2021, and what we saw was that money supply chart follows the S&P 500 like verbatim. You see really from the 90s all the way to 2008, very slow incremental stimulus and augmentation, very, very slow. And I used the chart. I don't have it here today, but I had it in last week's podcast. So go back and watch the podcast from last week because I do have that chart on there. You can see that it's just going very slowly, slow growth on stimulus from the Fed Reserve. And then in 2008, we had a sea change moment where the Federal Reserve really became they went into this, what we call MMT, modern monetary theory world of everything is too big to fail. GM in 2008 is too big to fail. So Bush 2 basically said, we will bail out GM. Obama came in January of 2009 and started bailing out GM as Bush had committed to. So we bailed out GM. We bailed out all of the banks that had the toxic assets on their balance sheet. We call that TARP, the Troubled Asset Relief Program. And then we moved into quantitative easing 1, 2, 3, and we haven't stopped since 2008. What you can see is literally the S&P 500 tracks exactly to the Federal Reserve stimulus from 2008 all the way to basically coronavirus. And then after coronavirus, it just jumps straight up because you know that the government created $10 trillion since coronavirus occurred in the United States. Globally, the rest of the world did 20 trillion combined, and the United States did 10 trillion alone. So the issue that you have with equities is that we really are expecting black swan event this year, because we are expecting, and we're in the process of the dollar losing its singular reserve status. And we're also losing the ability to print dollars without massive repercussions. So the Fed got in its head since 2008 that they could just print and stimulate, and inflation would remain relatively low. And that is a supernatural economic phenomenon that cannot continue indefinitely. As you print more and more money, you will decrease the value of your money, because you have to understand the universe that we're talking about in economics here, right? We have this universal world with almost 8 billion people on this planet, on all the continents. And those 8 billion people can be economically productive to produce so many goods and so many services on an annual basis. And beyond the production capacity, that's all the capacity that we have. So as we print more money, we aren't creating more goods and services to buy. That's finite, or it's limited. What we're doing is we're just increasing the money that will buy those goods and services, which basically means higher money supply divided by the same amount of finite goods and services means that cost will go up. So the Fed is finally, since 2008, entered the real world of real economics, where when you print money, you print massive money, you get massive inflation. Modern monetary theory, I believe, should be able to end and be put to bed as a non-viable economic theory and philosophy now that Corona has happened and we did print $30 trillion globally, and we have inflation absolutely globally. Now, we're not yet to the point of hyperinflation, but we have to ask ourselves, are we not really? Because remember, the federal government in the United States changed CPI, or the Consumer Price Index, to core CPI, which core CPI excludes intentionally food and energy, gasoline, which are our two most increasing, price increasing categories every year. So they want to take out the extremely inflationary food and energy, but yet that's what, besides housing, has really had a huge increase for all of Americans. So we don't really like to hear that food and energy are out of the core CPI number, which is what the government uses to benchmark inflation, set policy on the Social Security, and for inflation adjustments and those kinds of things. So equities has trended up as we have tracked the Fed Reserve stimulus. Equities have trended up just with it. And as we now have entered, in June, we entered into what we call basically running off the balance sheet. So instead of economic stimulus, we're actually in economic contraction, and we are contracting the money supply. We're sucking that money supply back in. And so what you'll see is if the market went up to an inflated point, it is going to be pulled down as the quantitative tightening, which is the technical name for it, begins in earnest this, with June as it started. And of course, the other thing is we know that the Fed is going to give us 50 basis points June and 50 basis points in July. And those are pretty much already baked into the market. So not getting those would make the market have a little bit of a heyday for a day or so, would be great short-term news. So all of that to say, equities are a problem in 2022. Because not only do we see white hot inflation all across the world, but we also have unprecedented global change and movements between Russia, China, India, the Middle East, and Europe regarding sourcing and purchasing of energy products. So natural gas and crude oil, basically. Russia used to sell, like Saudi Arabia, like all the OPEC nations, although Russia's not OPEC, in US dollars. That was part of the deal for the petrodollar, and the dollar is the world reserve currency. And since our sanctions, when Russia invaded Ukraine, we sanctioned the West, meaning NATO, and the United States sanctioned Russia, and Russia retaliated by saying we will only sell energy in either gold or rubles. And that has had a tremendous effect with realigning of all of those countries I just mentioned and those territories I just mentioned on how they get their oil and in what currency. So this is the first time we've really seen the petrodollar threatened since 1974. That didn't end in resolution, and it is a big problem. So equities are going to have a downward trajectory naturally in 2022, simply because the accommodative stance of the Fed has ended, and we are now in the hawkish, retractionary, non-stimulus, almost like sucking the stimulus back in. So we expect that to happen. However, we expect 2022 to have even more equity problems globally because of the fact that this US petrodollar problem has now stimulated and made countries like Israel, and I've mentioned this before on the podcast, that has started to replace their dollars for reserve currencies with the Chinese yuan. So we have to really be mindful that this is a sea change. And I mentioned it last week, but I'll just quickly mention it again. The Bank of International Settlements, the World Bank, the IMF, all of these institutionals, global institutions, do not like the US being the world's sole reserve currency. It gives us too much power, too much authority, too much ability to borrow and spend and do what we want that will help our citizens and not the rest of the world. And so they want that to end. So equities are a problem. Now, the thing I will say is normally in normal market cycles, we would normally say, okay, we're not going to be in tech heavy NASDAQ, which is where all of the long-term growth comes from tech stocks. That's too speculative for this year. It saved us through Corona. It saved us through really, the 2008 on. It was big tech that really, came out strong and helped us through all the challenges we've gone through since 2008. But that is not going to be the winner in down times. I mean, people are not going to go speculative longer term prospects on big tech when they're looking to wade through the financial storm. So a normal market cycle that would be coming down, we would normally say, hey, the safety equity pieces are going to be your utilities, because people still need to buy, electricity. And when they're laid off, the market's not doing well, we still have to buy our electricity. We'd also say consumer staples, because people still have to eat. They have to go to the grocery store. So utilities, consumer staples, any of the kind of recessionary proof sectors is where we would normally look to move equity positions, and we would just sort of rebalance and position out of maybe more aggressive growth stocks and tech stocks into these more recessionary proof things. The problem is when you have a potential black swan event, when you have a market rout, when you have a sea change macroeconomically globally, which is what we're looking at for 2022. That's what we're looking at for this year, then no sector is going to escape unscathed. There is no safe sector, not utilities, not commodities, not staples. There's nothing safe when you have a market rout down. You can go back and look at the 2000 to 2002 .com crash and see that and verify that all sectors are down. They don't go down the same amount, but they're still all down. You can go back and look at the 2007 through 2009 GFC, global financial crisis, and see the same. So if you're thinking, well, I'm just going to, my broker said, hey, we're just going to go into, utilities and staples, and you think you're going to be fine. And I will again say that this is a sea change year. And so all sectors will be universally impacted. Let's move on to the next category, which is debt and bonds. And so a lot of people think, well, bonds are going to be a great location to park some money once rates go up. And that could be true once rates go up, once rates normalize to some level. I think the Fed is trying around a 3% kind of area for Fed funds. And that's a huge increase coming off of 25 basis points to 300. Obviously, that's a huge increase. But you have to understand the inverse relationship between bonds and their current market value. So I've given you this example before, but for those of you that are new, I will explain the example again. And the example is if I go out into the market in 2021 and I buy a bond for $100 that has a coupon rate of 5%, that means if I hold my bond to fruition, to maturity, and let's say that this is a 20, I'm just making up numbers here, 20-year $100 bond at 5% in 2021, I have to hold that bond for 20 years to get my 5% and get my maturity of my principal back. So if you have a zero coupon bond, you get no interest payments. You get all of the interest and the principal back at the same time. If you have a coupon paying bond, then you'll receive interest along the way. So if I decide in 2022 to go into the market and sell my bond, well, now the Fed has raised rates. So now the new $100 20-year bonds that are being printed, again, this is an example, these aren't real rates. The example I'm using is in 2022, the new $100 bond has a rate of 6%. So think about this. If I have a bond in 2022 that I could buy that's 6%, why would I ever buy Rebecca's bond that she wants to sell when it was written last year and it's only got a 5% coupon? I wouldn't. No rational person's going to buy below market rate bonds when they can buy at market rate that are higher. So basically what I have to do to sell my 5% bond on the market in 2022 when going rates then are 6%, I have to discount the price or the face amount of my bond. I have to discount its principal to make the equivalent yield equal 6%. So if I'm getting a 5% return over 20 years, I now have to discount what I sell the bond at so that the person who collects the 5% coupon from the federal government as issued is actually getting a yield of 6% because they bought the bond at a discount. This is why as interest rates go up, bond values go down. If we look at the 20-year Treasury in the first few months after rates started raising in 2022, it lost over 20% in the first few months because the values were going down by 20% as rates were going up. So you don't want to go out and buy a bond necessarily in a rising rate environment because you're locking in a purchase that you know will be worth less money. It's not worthless, but it's worth less after all the rate hikes occur. So you kind of want to time your bond purchases to when rate hikes are done, the market has peaked at the rates, and then that's when you want to pull the trigger on a bond purchase. Certainly right now, existing bond values are going down because their face amounts have to be discounted, and it's going to continue that way until all of the rate hikes have stopped. We know for sure that we've got rate hikes pretty much baked in through July, but we don't know what will happen August and on. We know that the Fed will need to have further rate hikes if they are intent still on getting the Fed funds rate to around that 3% level. But what we can say is that the Fed does care about the market, and the Fed does look and tailor. They either speed up, slow down, or stay the course based on how the market responds to what they're doing. So we do know that they care about the market, and we do know that they will look at what the market is doing before they decide in August to continue on their rate hike journey. A lot of economists believe that they will see that the market just can't handle it and they will stop after July. And obviously that nobody wants the market to do so poorly that they have to stop. But I can just tell you, it's just not going to go this way. It's not going to be the way that everyone wants it to be, which is, oh, we had a little bit of a blip with the market coming down and the Fed's going to come in and save us on a white horse again. They don't have the capacity. They cannot do it because it is the essence of them printing money that, contributing with other factors, got us into this position in the first place. So you cannot fix a problem you created with the same tools that created the problem. So that's not going to happen. So we need to get into the mental mindset that 2022 is a sea change year for equities, and the Fed is not going to come in and be our savior this time. So that's the area of debt and bonds. The other thing I will say is that bond fund managers, a lot of people aren't buying bonds individually anymore. They're not going to the U.S. Treasury and buying a bond and holding it to maturity. Instead, what they're doing is they're buying bond ETFs, bond exchange traded funds. And what that means is they're relying on a bond fund manager to allocate the bond portfolio accordingly to the risk, and then to manage the bond portfolio and to be rolling bonds off and rolling bonds on as things change. So you might think, well, that's good. I have somebody who's managing the bonds. But the problem is what we've seen in the last 36 months and really the last 24 months is a lot of bond fund managers peppering in for the first time ever. This has not happened before. We see them peppering in high yield, or i.e., junk bonds, because the yields have been so arbitrarily low since 2008, since we really went into that too big to fail mentality with the Fed, that we do not get yield on bonds. And so in order to get actually attractive yield, we have bond fund managers that are folding and baking into their overall portfolio junk bonds below triple B credit grade, so double B, B not rated, and below B, which would be C and beyond. So that's the deal on bonds and the challenge that we have with bonds right now as a safety haven. The third thing I want to point out is real estate. So a lot of people are interested in real estate. And to be honest, real estate is one of the best long-term hedges for inflation over the course of human time. Real estate, unlike a piece of stock, certificate paper, or a piece of bond, which is a bond, instead of paper instruments as asset classes that represent, some legal construct like the value of a company that's owned or something like that, like a stock or a bond would be. Real estate has got real intrinsic value, real land that's not going to go anywhere unless God destroys the earth, real land and real buildings with brick and mortar that we can physically and tangibly touch. So these are our real hard asset classes that we're getting into outside of the paper now. And real estate over the history of mankind has been a great long-term inflation hedge. The problem with real estate are its bubbles. So obviously the most famous real estate bubble in modern times is the bubble of 2007, 2008, 2009. It set off the global financial crisis. I don't know if you go back in time to that memory. If you remember, we were watching the news from Greece where all the Greeks were protesting the austerity measures that were being promulgated by the IMF and the EU, because they were a part of the EU and they were financially a nightmare and a mess. And they needed, the EU needed them to get in line. And that basically is a lot of austerity measures, a lot of pension funds that are just too lucrative for too long. I mean, a lot of European countries, people can retire in their 50s and have a pension till death. And that could be 50 years. It's enough of a stress financially on any system that it's an impossible thing to maintain over the long term, especially when you have a generation like in America, we have the baby boomers retiring en masse. So the real estate bubble is the problem. And real estate bubbles, believe it or not, are just aligned with interest rate policy. So the Federal Reserve has had extremely artificially low interest rates through accommodative, dovish policies, stimulative policies since 2008. And having these very low interest rates means that somebody who's got a provable income and has a job can qualify for a much bigger house on the same payment. Think about it. If you have normalized interest rates in the 5 to 7% range on mortgages, maybe you can afford, in that case, on a normal range, a $400,000 house. But if your rate is in the 2s and 3s, then perhaps you can afford, if the rate was normally 6% and you've got a 2-something rate, you can afford, in that mathematical equation, if it's completely linear, you can afford 3x of a house. I'll give you an example. We have a client who owns a real estate brokerage, has a lot of agents. One of the agents was giving an example of a woman who had a rate lock in the 3s that expired in April. To her no fault of her own, she had put multiple offers on multiple houses before her rate lock expired. She had extended it multiple times, finally had to expire. And she had put multiple offers, but she was getting outbid by cash buyers because, we're talking specifically now about Florida, which is Florida, Texas, were some of the hottest relocations from Corona that occurred. And so she basically had her rate lock expire in April. And by the time, the rate increases went into effect in May, instead of a $600,000 house, instead of the house that she was expecting, she was able to afford literally only a $400,000 house. So she went from like 600 to 400,000 just because of an interest rate increase in that singular month period. Now, if you think about that, if that's $200,000 for one person, one home buyer looking for a home, aggregate that at the entire country's level, all real estate home purchases, obviously residential real estate purchases are going to be affected, but also commercial credit is also likewise going up in cost and having an impact. So, what can companies do? Where can companies buy? Where can companies relocate? Do they want to move to these urban areas that are becoming more blighted since Corona? What do they want to do? So, real estate is heavily impacted by interest rate policy. And I know for a fact, from my example, from my own personal experience, I had multiple properties through the 2007, 2009 route, and we had to keep and maintain those for a good 5 years and weren't able to unload them until 2013. And then in 2013, I think we sold multiple properties within, the summer months of 2013, bam, 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 bam. So once the market recovered, we were able to do that. But you have to understand, you have to have the financial wherewithal to maintain those properties for all of that time. No matter what's going on with your tenant, no matter what's going on with the actual property, you're going to have to maintain that while it's potentially underwater until you can get it righted back up and then sell again. The other problem with real estate, I see two other problems with real estate. First of all, real estate experts, that's all they do. They build their entire portfolio in the real estate world, and they think that they're going to be covered. That's a problem. I say this to business owners. I say this to real estate investors. I say this to everyone. There is no one thing that is so great that it should ever have every last dollar you have. You should never sink every penny you have into a business. If the business is worth its salt, it will produce cash flow for you that you can take outside of that business and move to a safety vehicle, or at least what I call the parallel wealth track. We always want to have a parallel wealth track. So one of the biggest issues with real estate investors is that they get into that world and that's their only world. They have blinders on to anything else. That's a problem, because if you happen to die when there's a bubble, if you happen to need cash flow during a coronavirus, when the federal government and the CDC come out and say you cannot evict people, so your tenants stop paying your rent. Maybe you carry a mortgage on that property, so your mortgage is still due. You have a lot of issues that come up with real estate when it comes to evictions, foreclosures, and all of those things legally. The other problem with real estate is the tax issue. The tax problem that I see coming is a lot of people have built millions of dollars in real estate, and the way they do it is they use the 1031. So they basically get real estate income coming in. They depreciate that through the depreciation mechanisms that is allowable under the IRC, the Internal Revenue Code. They appreciate that down to what we call a zero cost basis. So now they have no cost basis. They can do no more shielding of income through depreciation and non-cash expense. So what they do is they then sell that property. They take all of that gain, which the gain is 100% of the sale price, because remember, they have zero cost basis. So there's nothing left for them to shield. So that's a big gain. They take that gain, instead of paying the taxes on it, they roll that gain over within 6 months. It's called a 1031 exchange into a new property. That gain now basically goes into the new property to buy. And we start the cycle all over again, depreciating it down and shielding a lot of our cash flow. They don't wait. So they don't mind that by the end of their lifetime, they might have 20 properties that all have zero cash cost bases because they've depreciated everything. They don't mind that, because their intention is that they will die with these properties in their personal name, and the properties will get what we call the 1014 step up at death to fair market value. So let me say I own 20 properties. They all have zero cost basis because they're all fully depreciated. They're generating, $200,000 of cash flow and rental income per year, just a rough number I'm just throwing out there. And all of them have a zero cost basis. And I'm not worried about it, because I think that when I die, my family will inherit it at the fair market value, stepped up on the date of death to fair market value. So 20 properties stepped up on the date of death is worth $4 million. And basically, all of that $4 million will be inherited by my family with a cost basis of that for, what I just said. So the bottom line is they rely on these two provisions working together to really give them a great tax sheltered situation for their whole life. This administration, Joe Biden, has already said that he wants to eliminate the 1031 exchange, and he wants to eliminate the 1014 step up at death. I want to tell you that I think as a tax attorney, these are proposals that will get a lot of acceptance globally, universally is what I should say, rather. I mean, in the US, the US policy, they will get a lot of acceptance in the US because remember, the easiest tax to ever get through is the estate tax. People look at the estate tax as a rich person's tax. They don't care. You have to have X amount of dollars before you even get it. It's the same thing with the 1014. Do you really think people are going to have a problem not allowing your assets to step up to fair market value at your death so that you can avoid taxes that you've avoided your entire lifetime? The answer is most Americans, more than half of our Americans, we have about 50% of Americans that don't pay any tax. In 2021, it was higher because of Corona. In 2020, rather, it was higher because of Corona. It was closer to 60% of Americans didn't pay any tax because of layoffs and Corona and all those things. But the point I'm trying to make is when you only have 40 to 60% of your population paying all the taxes, you have this other group that votes that are very happy for you to not get that 1014 step up at death so that they can collect more taxes. So I do see that the tax scheme with real estate will change, and it's going to be something that will be very hard to rely on from a planning perspective and planning purposes. And finally, the last thing we will talk about here is commodities. So commodities, we're talking about precious metals, we're talking about energy in the form of crude, natural gas, all kinds of commodities. And, commodities, I'm going to be honest, this is going to be where it's at in 2022. This is going to be the tool and the leveraged position that will really probably get you through the routes that are coming. Now, you can't do everything, and you have to really talk with an expert to know which commodities and why. But I will just tell you that when you're buying commodities, you're really investing in the fact that there is intrinsic value in the hard asset itself, and that you're relying on to get you through an inflationary period or a market route period. You're basically saying there is no safety in this market, but at least when I buy a commodity, I'm buying something that has identifiable value that cannot just collapse down. So I will tell you that this is going to be a strong tool for 2022 to get us through what is coming. But to give you specifics, it really depends on your individual situation, which commodity would be the best. But I do see commodities as the winner overall of asset classes because we are moving through a sea change year. And anytime that happens, commodities really are the asset class that is the reliable go-to to get us from one side of the pond to the other. It will get us through this transition. And that's why that will really help us. So I hope this podcast, which was longer than my normal podcast, helped you guys understand the 4 different asset classes that I reviewed today. There are alternatives there's a lot of derivatives that are based off of these 4 main asset classes: options, swaps, like I said, derivatives. There's all kinds of other asset classes that can be leveraged in safe ways against these 4 different asset classes. But again, all of that requires very personalized and customized planning. So I hope that this really helped you guys see what's happening in 2022 and why we have very unique challenges it's not normal that we have a bond problem this same year we have an equity problem. But if you have a bond problem because your equities went up because your Fed printed so much money since 2008 to really support your equities and kept bond yields low, then finally that got to a tipping point ahead where you had to raise interest rates. That is going to then have an immediate negative impact, not only on your existing bonds that have already been sold because interest rates are now higher, but also on your equity market. So this is why we're having both bonds and equities really routing this year. Until next time, my friends, take care. Have a great week.